Good afternoon.
We are group 16. We have three people, Charlie, Aaron, and Sandy. Uh, our topic is investor behavior in government bonds under interest rate risk. And this is our table of content. Next, let's move on our presentation.
First, let's look at the background. What exactly are government bonds? Simply put, they are debit securities. When you buy a bond, you are essentially lending money to the government. But what is the motivation behind this? We can look at it from two sides. For the government, the motivation is to raise capital. They issue bonds to fund public spending such as building infrastructure, schools, or supporting school welfare programs. For investors, the motivation is usually safety. When the stock market is volatile or the economy is uncertain, investors flock to government bonds to protect their capital. Now, let's move on the key characteristics that define government bonds. There are two main features you need to remember. The first is the sovereign guarantee. Because these bonds are issued and guaranteed by the government, they have a much lower default risk compared to corporate bonds. In the financial world, we often refer to them as risk-free assets, because the government has the power to tax and print money to repay its debts. The second characteristic is their role as a benchmark. Government bonds serve as the standard point for the entire financial market. The interest rate on these bonds is used to price other assets, such as corporate loans or mortgages. Therefore, they are the foundation of the global financial system. To summarize, these government bonds are essential tools for governments to raise money and for investors to find safety. Their characteristics for being a safe haven and a market benchmark make them incredibly important. However, even these safe assets face risk when the economic environment changes. So, what happens when risk rise?
I will talk about the interest rate risk in government bonds and how it affects investor behavior in short-term and long-term bonds. Interest rate risk in government bonds refer to the sensitivity of bond prices to change in market interest rates. Because bond prices move inversely to interest rates, when interest rates rise, the prices of existing government bonds fall. This risk becomes more significant for bonds with longer maturities. Short-term government bonds are less sensitive to interest rate changes. They have lower duration, lower price volatility, and higher liquidity. As a result, when interest rates are rising or when economic conditions are uncertain, investors tend to prefer short-term government bonds to reduce the interest rate risk and preserve the capital. In contrast, long-term government bonds are much more sensitive to interest rate movements due to the higher duration. Their prices fluctuate more strongly when interest rates change. For this reason, when the investors expect interest rates to rise, they usually reduce their exposure to long-term bonds to avoid the potential capital losses. But however, investor changes when interest rate expectations reverse. When investors anticipate falling interest rates, they increase demand for long-term government bonds to lock in higher yields and benefit from price appreciation. In addition, long-term government bonds may provide a crisis alpha, meaning they can perform well during the market crisis as falling interest rates and flight to safety behavior supports bond prices, helping protect the portfolios when risky assets decline. This behavior can observed in real market. According to Reuters report in September 2025, investor expectations of upcoming Federal Reserve rate cuts led to the increase focus on the bond duration. As a result, many investors bought the longer-term government bonds, such as 10-year maturities, to benefit from potential price gains if interest rate fall. This case clearly illustrates how expectation about interest rate drive investor behavior in government bond market.
And I'll talk about how the investor choose government bonds when the economy is risky. First, I will explain our research question. Our main research question is how do investors change their bonds choices when economic risk become higher. We will use a mini case of US government bonds from 2023 to 2024. During this time, interest rates in the US went up a lot. Short-term bonds rates went up quickly, but long-term bonds price went down. Long-term bonds change more when interest rate move. So when interest rate go up, long-term bonds become more risky. Because of this, many investors sold 10 years bonds and bought 2 years bonds. Short-term bonds gave better returns with less risk. And the next part is implications. For government, higher interest rate means it costs more to borrow money. It is harder to pay old debt with new debt. Using more short-term debt also brings more risk. For financial market, bond prices change more often. Most trading moves to short-term bonds and long-term bonds are less popular. This shows the worries about future recession. And for economic, high interest rate increase the chance of recession. Companies spend less money, and people also spend less money. Investor behavior show less confidence in long-term growth. The conclusion. Government bonds are not always safe when interest rates are high. Investor choice depend on the economic and interest rate expectation. Moving from long-term bonds to short-term bonds show how investors react to risk. Bond market changes help us understand future economic conditions. Thank you.
This is our reference job distribution table, and that's all for our presentation. Thank you for listening.